Right. Morning, everyone. Welcome back to our morning kappa at 8. I'm Joseph here. So today we have a few company results report. I'll shorten my sessions. I just focus a few important points. Yesterday, right, we just understand that Trump have hold off the U.S. Latest plan attack on the Iran, right? So the sentiment on the crude oil has become on the upside. You can see that the crude oil have stay firm above $100 per barrel and is resuming the upside movement right now. You can see that the crude is heading towards the 110 level. At this juncture, we'll still keep a bullish bias on the crude oil. As you can see, when the crude oil went up, right, the markets tend to be a bit cautious. A few things that we also learned that the U.S. Expectations on the interest rate are also skewed towards on the upside, right? Fearing on the inflations. That will give a bit of selling pressures on the growth stocks right now. And meanwhile, post the Trump and Xi Jinping meeting, nothing much of a big deal has been announced. We can see that the first reactions was on the Friday. Hang Seng have actually came down sharply with a long bearish candlestick. And yesterday, Monday, the second day after the meeting, right, corrections continue to be seen in the Hang Seng market, right? So sentiment is more negative in the China market right now. Hence, if you're looking at the Hong Kong market, it's better to go for defensive stocks. Think that the growth stocks or the tech-related counters in the Hong Kong market have a strong selling pressure right now. Now, then on the other thing is that during 2 weeks ago, right, at the futures symposium, right, we mentioned about this indicator that I call it the US 10-year real yield, right? The formula at TradingView is US 10Y minus TY 10YIE. So in short, it's actually a 10-year bond yield, right? Minus of the 10-year inflation's expectations. So both instruments, the 10-year bond yield and the inflation expectation, these two instruments are tradable product. It's not a policy number, it's a tradable product. So when the traders trade that shows the market expectation, and you can see that the line is actually moving upwards. It shows that the bond yield have grew faster than the inflations. Hence, when this is happening, right, I mentioned that this will have a negative impact on the gold. As you can see also yesterday, gold price have a selling pressure for the past 1 week now. For the 2 weeks time frame, right, gold was moving sideways. There was a time that actually make a rebound. But if you can overlay this indicator, right, on the gold price, I can see that this indicator is showing you a strong divergence signal that you should stay on the bearish side for the gold, right? And that proved to be correct. The gold hit the 20 days moving average and it turned down. And likelihood today is going to breach the 4,005 level. So with this indicator, right, you can have a better advantage. I call a trading edge, right, against the other traders that are looking at a gold, right? So this is another piece of information that I'd like to share with you. As of yesterday, right, we mentioned about the cybersecurity counters in the US market and continue to see their funds moving into a cybersecurity counter. Firstly, by CrowdStrike, have a positive returns on Monday. And then also yesterday, we published a report on Sentinel-1, right? The stock also went up by another 4% yesterday. Now, in line with the higher oil prices, the ExxonMobil also went up yesterday night as well. So these are the two things that I think the market is looking at while the tech stock is undergoing corrections at the US. So meanwhile, we stay bullish bias on FKLI and bearish bias on the FCPO. As for Malaysia trading stock this morning, firstly, you look at Top Glove, the break paths are 80 cents, heading toward 86.5, followed by 93 cents. Downside support is 73 cents and half. Secondly, Rahim have a bullish candlestick yesterday and climbed above the 2 ringgit 8 cents. So testing the 2 ringgit 19 cents and followed by 2 ringgit and 30 cents. Downside support is 1 ringgit and 97 cents. So we have two breakout stock, Top Glove and Rahim in the Malaysian market today. So I'll stop here and pass on to Adam on the company results report. Thank you.
Okay, good morning everyone. Today we have a results review on Suncon. So Suncon released its first quarter 2026 results where core earnings of 114 million ringgit were broadly in line with our and Street expectations, meeting 25.6 and 27.3% of ours and Street's estimates. And the core earnings of 114 million ringgit for the first quarter of 2026 was around 40% year-on-year higher, but about 26% year-on-year lower. The main reason for the year-on-year increase was due to the finalization of accounts for certain data center projects. And in terms of its order book, currently it's about 8.2 billion ringgit versus about 7 billion ringgit a year ago, with active tender books about 15 billion, predominantly made up from data center projects. In terms of year-to-date wins, it's at about 3.6 billion ringgit versus our 6 billion ringgit target replenishment for FY26, with about 2.4 billion ringgit left to meet our target. We view that it is achievable, given that we see that Suncon could win about maybe 1 billion worth of projects from Sunway, and maybe another 1 billion plus of jobs coming from data centers, as there were some data center projects secured last year which were only for core and shell. So there's likelihood that they could win the mechanical and electrical package for the same data center jobs. So all in, we make no changes to our earnings estimates, given that earnings were broadly in line. But we do roll forward our valuation based to FY27 from FY26. Hence, we derive a new target price of 8 ringgit and 33 cents. So that's about it for Suncon. I'll pass on the floor to the next speaker. Thank you.
Okay, thank you, Adam. Morning, everyone. Let me continue with results review on 9th Speedmart. We are upgrading the stock to a buy from neutral with an unchanged target price of 4 ringgit and 2 cents. 9th Speedmart first quarter results came in within expectation. Net profit of 189 million was up 30% year-on-year. This is at 26% of the forecast. And if we look at the sales, it was up 18% to 3.1 billion. This is very much a function of net new store additions of 253 stores. And same-store sales growth was recorded at 11.1%. This is driven by the longer operating hours, whereby they open 1 hour earlier starting in July. And of course, SARA program has also played a part, which now accounts for 5% of the total sales. Gross margin expanded quite healthily by 1.1 percentage points on growing economies of scale. And consequently, we saw a 0.8 percentage PBT margin expansion as well, to reflect the improved operating leverage, with OPEX per revenue now moderating to 12.3%, which is a 0.3 percentage point lower as compared to the same period last year. On a Q-on-Q basis, revenue was rather flattish, but we saw a 1.1 percentage point uptick in gross margin. This is on a more favorable product mix due to the expansion of Sarah product categories to cover more products, and of course, the better seasonality related to Chinese New Year in the first quarter. Correspondingly, first quarter net profit saw a 22% surge Q-on-Q, with margin exceeding the 6% mark for the first time in the group's history. On the implications of Middle War conflict, management has not seen or expecting any sort of material cost increases or supply chain disruptions, at least in the immediate term. That said, any cost increases will be passed on to consumers to protect its gross margin. And in terms of the electricity and diesel cost inflation is very much manageable at this point in time as well. Consumer sentiment has not changed, or in terms of the behavior, it has not changed significantly, but management do see some a more conservative spending pattern within the consumers at this moment. Our expansion target remains at 250 stores in Malaysia, and management is not looking to add more than 10 outlets in China, as the venture is still very much at an experimental stage. Post results, we make no changes to our earnings forecast, and our target price remains at 4 ringgit and 2 cents. We upgrade the stock to buy. We believe our valuation is looking more attractive now. And given that 99 fundamentals will remain resilient amidst the ongoing market challenges. Promising earnings growth will also be supported by the increased budget allocations for Sarah this year, and the ongoing continuous robust outlet expansion to deepen market penetration. So all in, upgrade the stock to buy with unchanged target price of 4 ringgit and 2 cents. That's it from me. Thank you, and I'll pass on to the next speaker.
Yeah, thank you, Siang. So today we've got KLK's results. This is the results for the first half of the financial year, September 2026. So if you look at the first half numbers, it came in at 54 to 58% of our and consensus full year estimates. However, we deem this to be in line as KLK has yet to consolidate its associate Sintoma's losses this quarter. If you recall, in the first half of 2025, the associate loss that they recognized was 48 million ringgit. And that was due to a delay in Sintoma's results announcement. If we look at second half of FY 2025, Sintoma recorded a statutory net loss of 83 million pounds. However, we think that this will likely be offset by KLK being able to now equity account for its 24% owned associate MP Evans, and this will start to come through from April 2026. MP Evans' profits for the full year is estimated to be around about 100 million USD. KLK also declared an interim dividend of 20 cents for the year, which is the same as what they declared last year. In terms of FFB production, the FFB production fell in the second quarter by 15% quarter on quarter, but rose 6% year on year, bringing the first half to 6.4% year on year, which is slightly above our FY 2026 growth assumption of 4.7%, but in line with management guidance, which is mid to high single-digit growth. In the 7 months of the year, FFB output has narrowed slightly to 4.8%, so we are keeping to our FFB growth assumptions, which is 4 to 5% for FY 2026 to 2027. KLK recognized some 121 million in fair value losses on derivatives during the quarter, and this is because they have forward sold apparently a substantial portion of their Malaysian production, resulting in mark-to-market losses on the derivative market when CPO prices spiked. They are not very forthcoming on the volume and pricing of the forward sales, but we would expect that these losses would reverse in the following quarter, given that prices have already, given that the the mark to market losses would given that the prices would be reversed in the following quarter, so we wouldn't see this mark to market losses in the third quarter of the year. Unit costs rose quarter on quarter but fell year on year. So they have applied their fertilizer for the year at about 50%, and they have bought their full year FY September 2026 fertilizer requirements at a single digit prices higher year on year. So unit costs for the first half was around about 2,000 ringgit per ton, and they're expecting it to maintain at around this level for the full year of 2026. If you look at downstream margins dropped quarter on quarter to 0.05% from 1.5%. And this was dragged by lower profits from the oleochemical segment, which in turn was partially mitigated by lower losses from the refineries and other segments. Going forward, however, KLK is starting to see improved sales volumes from the oleochemical segment. And we believe that they will also benefit from the higher crude oil prices, which will benefit their substitute petrochemical products. So we will see some improvements coming from there. And they also note that the losses from the refinery and kernel crushing margins plants have also narrowed significantly. So we're keeping to our downstream margins assumption, which is 1.5 to 2% for FY26 to 2028. All in, we have tweaked our earnings up by 2.8%, 4.7%, and 4.3% for FY26 to 28 after imputing in MP Evans profits and updating our forex assumptions. We note that valuations have already retreated to a more attractive 17 times FY27 PE, which is at the low end of its peer range. So in view of this, we are upgrading the stock to a buy from a neutral with a target price of 23 ringgit from 22.30. Let me stop here and pass on to David. Thank you very much.
Yep. Thanks, Leng. Morning, everyone. So we have the Affin's first quarter results report today. The first quarter net profit came in at about 135 million ringgit. This was up about 6% Q on Q and 9% year on year, broadly meeting our and consensus expectations. The first quarter ROE was about 4.4%, still trailing the 5% target. But Affin was somewhat optimistic. They can narrow the gap ahead if the Middle East war ends by June. Now, just a bit on the results. The first quarter operating income was actually very robust. It was up 20% year on year, and it was supported by both net interest income as well as non-interest income. And you'll see that quite a fair bit of this was coming from a deal-related syndicated financing. So that actually lifted loan growth as well as provided them with a bit of fee income in the first quarter. But the stronger operating income was actually partly offset by higher credit costs, which rose to 34 bips this quarter as compared to 5 bips a year ago. And that was because asset quality deteriorated with the gross impaired loan rising by about 10% Q on Q, coming from SMEs and also a couple of corporate names. And by sector, this came from manufacturing as well as trading. If you look at other highlights, because of that deterioration in asset quality, loan loss coverage moderated to about 70%, and that's probably one of the lowest among the banks that we cover. So going forward, FY26 guidance was unchanged. Now, again, Affin's base case assumption is that the war ends by June. Oil prices normalize shortly after that. And based on that, management thinks that they have a very healthy loan as well as IB pipeline, and the execution as well as a drawdown of this pipeline should be intact if the base case holds. A more prolonged scenario, however, then they will need to relook at some of the targets and guidance they have set. The deterioration in asset quality at the moment, management thinks was largely seasonal, but they were unable to, totally rule out that this was because of also cost escalation from the Middle East conflict. Lastly, on the upcoming Basel III reforms, the impacts about 10 to 30 bips uplift to capital. But as management has said previously, the focus is actually to grow rather than returning the capital back to shareholders. So for now, given that the results are broadly in line, we keep our forecast unchanged. Our target price also is retained at 2 ringgit 60 cent. We are keeping our neutral call on the stock. Okay, that's all from me and that's all from us today. Thank you for joining us. Happy trading and see you again tomorrow at 8 a.m. in the RHB Morning Kappa at 8. Thanks and have a good day.